Can you please explain the Treasury bond inverted yield curve and how it affects the market? An inverted yield curve, which you're starting to see an inverted yield curve today. The 5-year Treasury has a higher yield than the 10-year Treasury, which is typically not the case. So you have 2-year, 5-year, 10-year, 30-year, and typically the further out the Treasury, so if it's a 2-year, 5-year, 10-year, 30-year has a higher yield than the 10 has a higher yield than the 5 has a higher yield than the 2. That's interest that you'll get paid for owning one of those time frame bonds for the US government, okay, for the Treasury. They're called Treasury bonds, and that's what they're called, Treasury yield. Yield is the interest rate that those bonds will pay you. It's not a good sign when the near term, like the 2-year, has a higher yield than the 10-year. Okay, the 2 and 10 are the biggest, most important yields that you need to pay attention to when you're talking about the possibility of a recession. We've never had an inverted 2 and 10 without there being a recessionary environment, and you're getting pretty damn close. The yield curve is flattening, which means the distance between the yield on a 2-year and the yield on a 10-year is shrinking. Okay, when the yield steepens, that means that the gap between the 10-year and the 2-year, or 30-year and the 5-year, is widening. Right now, you've got, I forgot where, I don't know where we closed today. On the 10-year, we closed around 2.25, 2.26, somewhere around there. But the 2-year is now over 2%. When you have a 2 to 10, the spread between the 2-year Treasury yield and the 10-year Treasury yield, when that gets down to 25 basis points, which is right around where we are, that's dangerously close to inverting, which means, so let's say next week, if the 2-year Treasury goes up to 2.3% and the 10-year goes down to 2.26, that's an inverted yield curve. That means that the 2-year bond is paying a higher interest rate than the 10-year bond. That's a bad sign, and typically is one of the leading indicators that the bond market is anticipating a recession. So we're very, very close. Okay, you have about 25 basis points, maybe 27 basis points of a spread. I didn't see where it closed, but I'll check that. But we were around 25 basis point spread between the 2 and 10s. So that's very, very, very close.